Welcome to the Explainer. Okay, let's dive right into this. If you've opened a browser or turned on a news channel anytime recently, you've undoubtedly heard the panic, the AI bubble. I mean, it's literally everywhere, right? But as we dig into the data today, something super surprising emerges. The mainstream headlines, they are focusing on entirely the wrong bubble. Today, we're going to break down the hard numbers to show you why the financial press is missing the real story and why the actual bubble isn't about stock prices, it's about a massive, silent productivity gap. Let's get into it.
4,800. That is the staggering number of times the exact phrase AI bubble was blasted across the English language press in just the first quarter of 2026. To put that into perspective, that's roughly a 5 times increase from the exact same time the previous year. The idea has spread like wildfire. Everyone is talking about it, but they're kind of talking about it for all the wrong reasons.
You see, those mainstream headlines are largely driven by these insane financial valuations. We're talking about numbers like Palantir's dizzying price-to-sales ratio of 86 at the close of Q1 2026. Just think about that for a second. To give you some market context here, median AI-exposed stocks were trading at a 22 times forward revenue multiple, while the rest of the S&P 500 is just sitting calmly at 7 times. The valuation premium is completely wild. And look, the bubble narrative feels completely justified when you look at those numbers. But as we'll see in a moment, the math actually points us toward a totally different structural problem hiding right beneath the surface.
Section 1. The wrong bubble. Bubble A versus Bubble B.
So here's the deal. We're actually looking at two very different bubbles happening at the exact same time. First, there's Bubble A, the asset price bubble. This is all about those 22x multiples we just talked about. If aggressive revenue growth doesn't happen, well, the multiples simply compress, investors take their losses, and the market reprices. It's painful for sure, but it's a completely reversible market dynamic. But then there's Bubble B, the expectation bubble. This is where boards, executives, and management consultants have baked completely unproven AI productivity gains right into their core operating assumptions. They're cutting headcount and making irreversible organizational changes based on a promise. If those productivity gains don't happen, the damage is structural. You can't just unfire your staff or unspend billions on stranded data centers. The cost of this expectation bubble is deep and it's permanent.
Section 2. The productivity reality check.
To really understand the reality on the ground, we have to look at a February 2026 working paper by the National Bureau of Economic Research. And wow, the scale of the disconnect here is massive. While 76% of surveyed firms are hyping up AI in their earnings calls or strategic plans, a staggering 90% of those exact same firms are seeing absolutely zero measurable impact on their actual productivity. None. Only 10% of these companies can actually measure a productivity gain from all this AI implementation. Now that is an enormous corporate communications problem.
But here's the glaring math problem. When the NBER asked executives to project their future AI productivity gain, the median answer was a mere 1.4%. Let that sink in for a minute. These same companies have stocks trading at a 22 times premium. To actually justify that kind of valuation, you need a 5 to 8% compounding productivity gain every single year for the next 5 to 7 years. Yet, executives are publicly projecting less than a third of what their stock prices imply. The math simply does not support the valuations, and it definitely doesn't support firing your staff in anticipation of AI taking over the whole shebang.
Now, I want to be super clear here. AI isn't useless. In specific domains, like code generation, we're seeing real, replicated, and durable 20 to 40% gains on routine tasks. Document extraction, 50% plus. It's real. But as we move into general management, the gains are negligible. There's just no reliable measurement yet. Healthcare diagnostics, less than 10% and mostly experimental. So while AI works great in narrow, specific tasks, when you aggregate that across an entire enterprise, across all the general management and varied roles, the firm-level productivity gain remains tiny. And that is exactly why that 1.4% executive projection exists. The aggregate impact is just incredibly small right now.
Section 3. The $650 billion CapEx trap.
So despite those tiny productivity gains, the big four tech companies are committing roughly $650 billion to AI infrastructure this year alone. If productivity fails, it's essentially a slow-motion train wreck. And here's exactly how it plays out. By Q4 2026 to Q1 2027, margin pressure hits hard. Companies that ramped up CapEx while prematurely cutting their payroll, they're going to find their revenue per employee just hasn't improved. By mid-2027, we see CapEx pull forward exhaustion. Basically, the depreciation tail from that 2026 spending hits earnings, but the expected revenue lift never actually arrives. multiples compress sharply. And finally, by late 2027 into 2028, we hit the final stage, expensive workforce restoration. Companies realize AI didn't actually replace human output, and they are forced into this desperate, highly expensive scramble to rehire senior labor at a massive premium. This is the observable failure mode of Bubble B.
Section 4. 5 indicators to watch.
So, how do we track which bubble is going to pop first? Well, here's some macroeconomic detective work for us. First, and absolutely most importantly, watch for a sustained growth of less than 2% in revenue per employee on 10K filings. If revenue per employee stays stagnant despite all these new AI tools, Bubble B is confirmed. Second, watch a forward price-to-sales multiples compress from 22x back down to 14x. Third, keep a close eye out for NBER follow-ups on that 1.4% projection. If it moves up, the bubble thesis weakens a bit. Fourth, look for Q3 and Q4 Big Four AI CapEx cuts in earnings calls. If they start cutting, Bubble B is already priced in. And fifth, look for a rapid migration to open-weighted enterprise adoption, moving away from expensive closed APIs. The rule of thumb here is simple. If 3 of these 5 indicators flip negative at the same time, the structural expectation bubble has officially burst.
Section 5. How leaders should prepare.
Look, this isn't just some interesting theory for economists. This is a massive transition that CFOs, corporate boards, and everyday employees need to navigate right now to protect their organizations. Number 1, CFOs, you absolutely must demand hard operational productivity numbers from every business unit running AI initiatives. No more vague strategic narratives. The gap between those two is your true risk exposure. Number 2, investors need to disaggregate. Treat the shovel sellers like NVIDIA and the energy infrastructure folks very differently than the companies simply promising massive AI-driven margin expansion. Number 3, boards, this is vital. You must stress test your 2027 plans against a mere 0.7% measured productivity gain. That's exactly half of the current executive projection. If your corporate plan cannot survive a conservative 0.7% gain, then your plan is the bubble. And number 4, executives have to stop pricing AI into the forward look beyond what the actual data supports, because the credibility cost compounds every single quarter.
Ultimately, it all boils down to this one stark reality. The cost of Bubble B is structural, not financial. A stock market correction, say dropping from a 22x multiple down to a 12x multiple, is definitely unpleasant, but it is entirely absorbable by the broader market. However, reversing premature layoffs, eating the cost of literally billions in stranded CapEx, and trying to unwind entirely new organizational designs, that is going to absolutely devastate a company from the inside out.
So I'll leave you with this final provocative thought. The real bubble, the bubble nobody is actually naming right now, is the massive gap between what executives have projected and what their workers can actually do with this technology right now. So, which side of the gap are you on? I challenge you to look closely at your own organization this week. Are your decisions based on measured operational reality, or are you operating on executive fantasy? Thanks so much for joining me for this explainer. Keep asking the right questions, and I'll see you next time.